Opendoor Technologies, a company that saw a 7-fold increase in stock value in the past 6 months and made instant millionaires overnight, has everyone questioning, who are they and what do they do? Is this a meme stock, or do they have a sustainable business model to justify its value? To understand how Opendoor makes money, we need to go back to 2008. In the early 2000s, banks issued a large number of subprime mortgages to people with low income and a poor credit history. When these people failed to pay the banks back, as expected, the banks took their homes and put them up for sale through a process called foreclosure. From 2008 to 2012, roughly 4 to 5 million homes went into foreclosure in the US. In some markets, home prices dropped by 50 to 60% from its 2006 peak. Before the financial crisis, most single-family rentals were owned by individual landlords with only a few homes. Large institutional investment was almost non-existent because managing scattered single-family homes was too costly and inefficient compared to apartments. However, when an asset goes on sale for over 50% off, Wall Street will jump on that bandwagon despite the inconveniences and management. In 2012, Blackstone founded Invitation Homes to focus on acquiring distressed single-family homes throughout the US, marking big institutional players' first step into the game. By 2021, Invitation Homes owned over $18 billion of single-family homes in the US. Other major institutional players such as American Homes for Rent and Progress Residential emerged around the same time. As private equities racked up bank-owned single-family homes on the market, serial entrepreneurs Keith Rabos, Eric Wu, and J.D. Ross saw another opportunity with homeowners who were financially struggling, but their homes had not yet been taken by the bank. In 2014, the three founded Opendoor Technologies and began its operations in offering cash to purchase houses from any willing homeowners who wanted a quick way out. This pitch not only attracted financially distressed homeowners, but it was appealing to a much broader audience for several reasons. One, sellers did not need to let their homes sit on the market for an indefinite amount of time. Two, strangers would not trail through their homes and intrude their privacy. Three, no back and forth negotiations. And four, no potential pitfalls that come with incompetent agents. Opendoor soon became the largest instant buyer or iBuyer on the real estate market. Ahead of its 2020 IPO, the company's market cap was around $18 billion. In a bull market, everyone can make money. The true test came in 2022. With the dramatic interest hikes, an emergency brake was pulled on the entire US real estate market. Opendoor went from an average gain of $16,000 for each sale in 2021 to an average loss of $28,000 on each of the 7,500 houses it sold in 2022. To make matters worse, in the same year, Zillow announced the complete shutdown of its iBuyer division after incurring a $300 million loss. Investors began to question the sustainability and profitability of the iBuyer model. Because of its underwhelming financial statements and continual losses, Opendoor stock plummeted and remained low until the most recent announcement. On September 10th, Opendoor announced the return of its founders to the board of directors and the appointment of a new CEO to lead the company's next chapter of building an AI-powered real estate platform. The new leadership change sent the stock soaring by 78% overnight. So is the rise of Opendoor another meme stock rally? Here's my take. Under the cloak of technology, Opendoor is in a very ancient line of business of buying, selling, and investing in real estate. It is operating in the largest asset class in America and arguably the safest. For decades, real estate investors have profited from purchasing houses off-market at a discount, fixing it up, and then renting it or selling it for more. Even with the high interest rates in the past few years, people were still making good money. I personally bought a house last year from a flipper's extra inventory for $330,000. He originally acquired the house for only $265,000 off-market just a few months earlier. That house appraised for $373,000, without any additional renovation. All Opendoor needs to do is to figure out how those people, like the flipper that makes $65K off of me, how are they successful, and copy and paste exactly what they do, then apply it to a much larger scale. Even if Opendoor decides to throw out the whole cash for house model, it still has a very user-friendly platform for buying and selling homes. In conclusion, in my opinion, Opendoor has very little reasons to completely fail simply because of the nature of its business. Worst case scenario, it can still be a successful traditional real estate business with a modern touch, just like Zillow and Redfin. My name is Hannah, an Atlanta-based real estate professional. Thank you for watching and see you next time.